My name is Anthony Page, and I'm Dean at FIU Law. I've been here for 3 years, and I am extraordinarily proud of our students and our alumni and all of the stakeholders that made this an absolutely fantastic law school. Thank you for joining us today for this session on the CARES Act and what you need to know about student loan repayment. And I must admit, I'm really curious because I really haven't the slightest idea what you need to know about this. It's my privilege to introduce Chad Torin. Chad Torin is president of the Private Client Group Division of Coastal Wealth, which is a mass mutual firm. And he is one of the top financial professionals in the country, and in fact was named Advisor of the Year last year in 2020, and he has a variety of various accolades within the financial industry. Of particular interest to us is one of his passions is providing financial education to underserved demographics. And so he regularly speaks to students, graduates, undergraduates, and so forth, because, well, students have all kinds of, typically student debt is their big financial challenge. Chad graduated from the University of Florida and has a bachelor's and a master's degree in accounting, and he also has a CPA license. More importantly for us, he became a Panther in 2013 when he graduated from our College of Law. So Chad Torin, we're very proud of you as one of our top graduates, and we're delighted you were able to make time for us to come back and talk to our students and future viewers about what the CARES Act means for student loan repayment. So thank you, and at this point, let me turn it over to you, Chad.
Thank you, Dean Page, and thank you to the alumni group for allowing us to talk today. One of the things that I realized during law school, and really have come to realize in every graduate level program, is that you become experts in your particular area of field, whether it's learning how to practice law, practice medicine, etc. But there's usually some sort of void in basic financial education. We start getting these salaries. What do we do with those salaries? But it starts earlier than that. Proper planning really begins with cash flow. And one of the biggest impediments that us as attorneys face when it comes to cash flow is our student loans, and really more importantly, what the balance, what the actual loan payments are on those loans. And since we're less than 3 months away from the CARES Act ending, which Kate, our loan expert, will elaborate on, I thought it'd be a really good time to start to educate a lot of the attorneys that went to FIU, because that's initially how I built my entire practice, was really helping attorneys both in their personal and in their business financial worlds. Why? Well, because I understand all of the pain points that everyone's going through, none bigger than student loans. And so, as I said, with the CARES Act coming to an end, those that have not made any payments on their loans are going to be forced to do so in the near future, which is why we've brought in Kate Hobesel today from Common Bond. Kate is director of Common Bond's Partnership Success Team and focuses on ensuring the effectiveness of strategic and enterprise partnerships. She has a bachelor's degree from University of Pennsylvania and is from Baltimore, Maryland. She's passionate about financial wellness and helping people achieve long-term stability, even when struggling with the burden of student loan debt. And so I'm going to turn it over to Kate, but we definitely want this to be interactive, so feel free to ask questions. I know Jasmine will be sharing contact information, in the chat, so that if anyone has any particular questions that they don't like asking in a group setting like this, feel free to email us, call us. We're always here to give consultations. And without further ado, I will turn it over to Kate.
Great, thank you, Chad. And thank you all for joining today. Really excited to share this information with you. So I'm just going to share my screen quickly. All right, so we are going to be talking about student loans, managing student debt, what the CARES Act means, navigating the loans that you're holding, really kind of understanding everything there is to know about education loans. So first, just to give you some background on who is Common Bond? Kind of how did I come into this conversation? So Common Bond is a company really exclusively focused on student debt. We were founded out of our own CEO's experience taking out loans to go back to school for an MBA. And that experience really inspired him to try to create a company that could serve student loan borrowers better. Giving them access to better rates, better customer care, a completely online experience, really trying to make it as easy as possible for people to get access to those savings. So we focus on student loan refinancing, also on originating new student loans, and then we also have some software tools that we offer to employers to offer out to their employees. But so we, Common Bond, have partnered now with MassMutual to help people think about their student debt, but in the context of their broader financial goals. As Chad's already alluded to, navigating what your monthly payment's going to look like, what you can fit into your budget properly is sort of some of those first decisions you need to make around your student debt and your general financial plan. And so by working with Common Bond and MassMutual side by side, you can hopefully make those decisions about your student loans and then kind of roll that into thinking about the rest of your financial goals. One other note about Common Bond, just something we're really proud of, is our social promise. We have a one-to-one giving mission where for every loan that we fund the education of a child abroad in need. To date, we've donated over $2 million. It's just something that we're really proud of, really at the core of everything that we do here at Common Bond. So now we're going to talk about student debt. So those of you who have student loans, you probably have a combination of two different types of student loans, federal student loans and private student loans. Now, pre the CARES Act, many people would just graduate from school, complete their education, put their loans into some sort of auto pay mode, some sort of set it and forget it. And that might be the last time that they really thought about their student loans. Or they might have treated their federal and their private student loans kind of all as one. But right now, because of the CARES Act, there are particular implications for federal student loans versus private student loans. So this distinction right now is actually very relevant. So federal student loans are going to be education loans funded by the federal government. They come in the form of direct subsidized, direct unsubsidized, grad plus, parent plus, Perkins loans. Now, those of you who have federal student loans know that if you took them out for your undergrad, they were capped at a certain amount. And if you took them out for your advanced degrees, then they were uncapped, but they also could be at sort of high interest rates. And so as a result, people often take out private student loans either to make up for some sort of funding gap or to be a competitive product to those graduate degree loans. Now, a private student loan is going to be an education loan from a private lender, such as Sallie Mae, or loans that have been refinanced with a private lender, such as a Common Bond. Now, I highlight Sallie Mae here because they are so common in the student loan space. There's actually a frequent misunderstanding that they are actually a federal lender, and they're not. They are private student loans. So once you have your loans kind of broken up into those two buckets, then we can think about what to do with these loans. So for your federal student loans, there are some programs that you can qualify for. So as you're kind of thinking through what your options could be, first, just will of course want to call out these in case you would be considering pursuing either of them. So the first is public service loan forgiveness. This is a federal program that only your federal student loans qualify for. And for this program, you need to work for 10 years in the non-for-profit space. You have to make 10 years of on-time payments and report your employment every year to the federal government. And at the end of that period, you can apply to have your balance completely forgiven tax-free. This is a great program. Unfortunately, there's been a lot of misinformation or bad headlines about people not actually qualifying and getting their loans actually forgiven at the end of this 10-year period, but we have seen that that's improving. And so if you are considering a job in the non-for-profit space, I would definitely say that you would want to keep your federal student loans with the federal government so that you could then qualify for public service loan forgiveness. So
I'll just add one thing to that before you jump to income-based, is it's very important to make sure that wherever you are working, whether it's public defender's office, state attorney's office, whatever it may be, make sure that that organization does qualify for the forgiveness, because where a lot of the problems that we've seen is that people think that they're with an organization where their loans will be forgiven, and then they're not. So then all of a sudden they have interest that have accrued for 10 straight years. The other thing is that if you notice the second bullet point that says make 10 years of full on-time payments, a lot of the litigation that's arisen has been because someone has missed 1 or 2 payments. And even if it's over a 10-year period, that is defaulting them out of this forgiveness program. So although it's there for you, there's very, very strict rules. So it's important to make sure that you're paying attention to them. The other caveat that I'll say is that whatever the federal government gives to you, they can take away. So there's always an administration that can come in and change these rules in terms of what the loan forgiveness might be. So it's really important just to be cognizant, of your balances, of what your payments are, so that you can, always make the most educated choice and not be on that set it and forget it model that, Kate talked about, that most people end up on just because they don't like thinking about their student loans.
Yeah, that's a really good point, Chad, especially just to highlight all the steps that are required for this program. Again, if for those that do qualify, it's a really great program, but it is a very active program. So just something you want to keep in mind if this is something that you would be interested in pursuing. Now, income-based repayment is another federal program that only federal loans qualify for. And this program is for situations where you have low income compared to your student debt load. And so then your monthly payments are adjusted to reflect your income as opposed to that debt. So often people, maybe as they're early in their career, kind of getting themselves more financially settled, this is a program that they might pursue so that they can still make payments on their loans, but make payments that fit their current budget. The one thing I would say about this program is that if you ever hear situations where someone says, I've been making payments on my loans for years, and yet the principal seems to have gone up, I don't know how this is possible. It's often because they were in an income-based repayment program, because the payments that you're making sometimes actually are not even covering the interest payments on your loans. So
I'll
while
elaborate on this one too. Sorry, go ahead, Kate, and then I'll elaborate, because this is something that I believe, a lot of the people on this call probably either were on or are currently on. So I'll let you finish what you were saying and then elaborate a little, because I was on it for a while.
Oh, no, I know you have personal experience with it, but I was just going to say, it does keep people out of default and in repayment. But as I think you're about to elaborate more on as well, it does have, it's not as simple as it seems sometimes.
Yeah, so from a financial planning standpoint, and that's kind of where I'll provide the commentary towards Kate's expertise in student loans. When you start out with your planning, it's always about doing things in the right order. So there's a lot of things that have to happen earlier in your career alongside your federal loans, whether it's building up emergency savings so you don't end up in credit card debt, saving for a home, whatever it may be. When you're starting out, the income-based payment may be great because your payments will be significantly smaller early on to allow you to do those things. But as Kate was alluding to, as your income rises, it's still a percentage of your income that your payment is based off of. So what happens is that eventually, as your income, as attorneys, we hope our income continues to rise. Eventually, it reaches a point where your income-based payments are substantially more than they would be should you just refinance. On point in case, I was on income-based for 4 years. What Kate was saying is 100% true, that your principal ends up growing. The amount you have to repay ends up growing because those income-based payments are not even covering the interest that's accruing. I'm very, very transparent in everyone that I work with. Just to give you an idea, my loans grew from 160,000 to 205,000 in a matter of 5 years or 4 years, just by being on income-based. So it's important to keep that in mind, because you see that second bullet that says forgiven amounts may be considered taxable income. Well, imagine 20 years of that happening, what that principal will grow to, and then getting hit with all of that as ordinary income tax when it is forgiven. So it's really important to be cognizant of that. And then also, like I said, there could be considerable savings by refinancing. And just to give you an idea, I ended up saving $700 a month when I refinanced from my income-based payment to a refinancing program. Just so happens I used Common Bond because they have the lowest rates. But whether it's Common Bond, SoFi, any of those companies, there's still going to be lower payments than your income-based payment. And so it's important really on a year-by-year basis to do that analysis and see where your payments end up, so that you don't end up in a situation where maybe you didn't even know you're paying $700 or $800 more a month than you needed to, when you could refinance and actually be eating away at that principal every month, as opposed to being stuck with something that's going to continue to grow and then you're going to have to pay tax on.
Yeah, no, I think that's really well laid out and really well explained. And I think one of the things that Chad often references that I really agree with when talking about student debt is that your student loan repayment plan can change throughout your financial life, and that there's different points in your life where you suddenly might be in a different type of repayment plan because maybe you've reached a certain income bracket, or your needs have changed in terms of your free cash each month. And I think that that's a great way that Chad is really helpful in these conversations to think through, as my needs change, my loans can also change. You don't need to just be in some sort of auto pay mode. There are things that you can levers you can pull to change what your student loan payment program looks like. So now I'm going to talk about the CARES Act for a minute. So we are in the middle of the CARES payment pause for federal student loans. This has been in place now for about a year and a half. And if you do have federal student loans, this is a program that I really encourage you to take advantage of. This is a unique opportunity where your payments are currently not due on your loans. And so you can really funnel those payments towards some other part of your financial life. That could be towards future investments, towards saving for retirement. It could be paying down other higher interest debt. This is really kind of your chance to leverage those payments. There have been communications from the federal student loan servicers that you should continue to make payments on your loans because the payments will go directly to principal during this time. Now that can be a great option for some people. The way I always look at it is if you're holding any other higher interest debt, then it is in your best interest probably to funnel your payments towards that debt. If you don't have any other debts, this is the only one that you have, then they're absolutely right that by making these payments, they'll go directly towards your principal. So sort of two options there, depending on what your situation currently looks like. So we are getting close to the end of the CARES Act, the scheduled end of the CARES Act, September 30th, 2021. What I will say is that this program has been extended several times already. And we often get a lot of questions about, do we think it's going to be extended again? What's our knowledge there? And so I'll give you kind of a window into what we've seen. And I'm also going to talk about federal forgiveness. There's been a lot of buzz about one-time federal forgiveness. So right now where we sit, there is currently no student loan forgiveness in any type of legislation or written in any legislation that is currently being proposed. So as of right now, there is no plan for any type of federal forgiveness. It has definitely been part of the Biden administration, something they've talked about a lot. There is the potential that it still could come in the future. Where we sit now is that Biden is currently assessing if he has the power to actually forgive student debt, if that is part of his under his scope or under his umbrella. They don't have a final conclusion on that yet. With the end of the CARES Act, we sort of expect that if they do end the payment pause and interest waiver, that would be coupled with some sort of announcement about forgiveness. So we would probably anticipate hearing more news by the end of this month, because they still need to give the loan servicers enough time to kickstart repayments, do what they need to do to start to get everybody back into repayment. Especially because, as Chad mentioned before, if you are on one of those federal programs like public service loan forgiveness, missing a payment can have huge negative impact on your ability to qualify for that forgiveness. So the servicers need to be sensitive to make sure that they are taking care of their borrowers and setting everybody up for success in terms of entering repayment. So I'd say we don't know anything for sure. We are definitely still waiting for news from the Biden administration. I would expect some sort of news by the end of this month. In terms of both if there will be any type of one-time forgiveness and also about the CARES Act ending. But of course, I don't have. Oh,
Okay,
go
I'm
ahead.
gonna add one little bit of commentary around the forgiveness, and it's really from the planning side again. There has been this talk about forgiveness, and it's a question that I get asked really with any person that I meet with that has student loans. My answer to them is always, let's assume that they do come forward and actually do give this for forgiveness. Would you even qualify for the forgiveness? And the reason I say that is there's millions of people in this country with student loan debt. Anytime the government comes out with some sort of program, whether it's the stimulus checks we just received or didn't receive because of income, that's kind of where I'm headed, right? When you earn too much money, you typically don't qualify for these federal programs. Just look at the income limits for a Roth IRA. That's not even a federal program. But if you're a single person earning more than, $135,000, you can't even put money into a Roth IRA. Why? It's too good of a vehicle. And the government doesn't want people with high incomes just socking money away tax-free. Same thing with the stimulus checks, right? They had limits on what your income could be to actually receive the stimulus check. And so I always caution people that if you do think there's going to be some sort of forgiveness, ask yourself if you think you're actually going to qualify based on what your income is.
Yeah, that's absolutely true. And for the previous proposals around forgiveness, the proposals always eventually changed to include some sort of income limitation, different things like that. So I'd say it's definitely a very valid opinion, and we'll wait and see. Hopefully, we'll have some more information by the end of the month, because I do think that the CARES Act has caused some people to be unwilling to take action even on their private student loans. They just are sort of in this wait and see mode, which is really kind of too bad, because we are in this particularly low interest rate environment. So particularly for those individuals that do have private student loans, we really want to encourage them to still think about what they could do with their private student loans during this time as well. So I'm going to pivot now and talk about refinancing. So we've just covered with your federal student loans, there are these programs that you could qualify for that you might pursue that are unique to federal student loans. And so if you are interested in any of these programs, you would not want to pursue refinancing those loans, because if you refinanced, they would then become private student loans. So that's why we kind of start with that group, just to sort of walk through when would I not want to refinance my loans? And it would be if you were pursuing any of those three programs. So now to talk about, what is refinancing? So refinancing is really just this idea that, as you grow throughout your financial life, you should be able to qualify for better rates on your loans. Particularly student loans, you might have taken these out when you were 18, you had no credit history, no income, and now, you've graduated with this great degree and a great job, you really should have the ability to get a better rate on that loan. And so if you do choose to refinance with Common Bond, we then pay off your old loan, and then you have a new loan with Common Bond at that better rate. And with Common Bond, you could refinance any type of education loan. So that would be a federal, private, Parent Plus, Grad Plus, co-signed, previously refinanced, previously consolidated, really anything that is an education loan. And one important note, just sort of, as you're understanding refinancing as a whole, when you refinance with Common Bond, your loan is still an education loan. There are some student loan refinancing companies that will refinance your education loan into a personal loan. And personal loans have different types of protections, and they also cannot be refinanced again. There is not an appetite for refinancing personal loans or a market for refinancing personal loans. So when you refinance and keep your education loan, you still have the ability to refinance again in the future, which I think is just a really important thing to keep in mind. So what are the benefits of refinancing? Why would someone refinance? The really obvious one, of course, is just savings, a lower interest rate over the life of your loan. But a few other things to keep in mind are simplicity. So when you graduate, you're going to have this big group of loans that you're dealing with because you took out loans for every semester. They could be different servicers. They could be private versus federal. It can be really pretty messy to kind of manage. But in refinancing, you have the ability to consolidate those loans all into one. So especially from the perspective of financial planning, much easier to be budgeting and planning around just that one monthly payment that you're working on, as opposed to a whole big group of them. Now, protections are really important here. Often when I speak with people and they say they haven't looked into student loan refinancing because they're worried about losing protections. And this is a totally valid concern because not all student loan refinancing companies offer the same level of protections. These are things such as deferment, forbearance, death and disability discharge. At Common Bond, we have best-in-class protections. It's very important to us. But as you're assessing options and trying to understand what might separate one company from another, these protections are going to be a really key feature. And this is all with no origination fees and no prepayment penalties. So no origination fees just mean that, unlike refinancing a mortgage, student loan refinancing is free. It is really just about getting you a better interest rate on your loan. And that's one reason that, I always say it's if you have these private student loans, especially that don't qualify for federal programs, or if you're not pursuing any of those federal programs, you should really at least consider refinancing because there is no cost. It is just trying to get you that better rate for your loan.
Just to give you an idea, as interest rates have continued to drop over the last year and a half, I've actually refinanced twice. Because as Kate said, there's no closing costs, there's no origination costs, there's no fees. So it's like anytime you can free up more money that can, be deployed potentially to something more effective, even if it's just building your savings, it's a win-win.
Yeah, absolutely. And I think what you've also touched on that's really important is that the interest rate environment has dropped so much in the last year and a half that really anyone who's refinanced outside of 1 year, we always say, it's worth looking at again because the rates have dropped so much. We are really in this very low rate environment. So it is a great time to consider this as an option. Also, no prepayment penalties. This is a really important one. So this is something you'll see across all education loans. It's a federal law that there can be no prepayment penalties for education loans, which means if you do get a large one-time bonus or just have a large amount and you just want to apply to your loans, you can always do that as long as they are education loans. So just something to always keep in mind. So what do you need to refinance? You do need to have good credit, typically a 680 or higher. You need to have student debt between 5 and 500,000. This can be a mix of federal or private. You need to have at least a 4-year degree from a non-for-profit school. And you need to be a US citizen or hold a visa to work here in the US or be a permanent resident. One thing just to call out, Common Bond is one of the rare companies that will refinance loans from visa holders, something that we're really proud of. So protections, I mentioned these earlier, but I think it's really important just to go through these really quickly. So these are kind of the 3 main protections that people talk about when considering student loan refinancing and thinking about, what separates one lender from the other. So I'm going to go through each and just define them so that you can be aware of them and keep an eye out for them, and then also tell you kind of how Common Bond stacks up.
And they're also typically the reasons that people don't want to refinance out of the federal program because they're afraid of losing these protections. And it's kind of a misconception that people have that you actually lose them if you do refinance. Absolutely. And the part of the nervousness there, which is totally real, is that maybe there are some lenders that you could lose some of these protections with. And so that lack of certainty just results in people, not taking action, which is always too bad because then they're overpaying on these loans that they don't need to. So the first to know about is deferment. This is the ability to pause payments while returning to school. Many of you may have taken advantage of this program in the past with your federal student loans. And with Common Bond, we offer 32 months of deferment over the life of the loan. Forbearance is similar. This is the ability to pause payments in the event of financial hardship. With Common Bond, we offer 24 months over the life of the loan. And the process to do so really just takes a conversation with our care team, our customer care team. That's our customer service group. That's how we refer to them. To give you some context, SoFi in our industry, for example, offers 12 months of forbearance, and you have to show proof that you've lost your job. That's their definition of financial hardship. Then lastly, death and disability discharge. So this is a protection that federal student loans have that is especially important to those of you who might have really high loan balances where, should the borrower pass away or become permanently disabled,
we will forgive the full balance of the loan. So again, this is a federal protection that we at Common Bond have decided to maintain because we do think it's so important, and really to make sure that your loved ones wouldn't be left behind with your loans.
All right, Kate, I'm just going to chime in real quick again about the disability discharge. The reason why is that the definition of disability, either both the federal loan or even to some extent under some of the refinancing companies, is that really you can't do anything. You're unable to work, you're alive, you're unable to work. There are individual plans you can get to actually protect your student loan payments should you become disabled per the definition of a private company that's in protecting student loans repayment, student loan payments. And the definition is much different, where it looks at your specific job as an attorney and it says, can you or can't you do this job? But also it's not just that you're totally out. If you are out or working 50% less or 60% less and still working, a lot of the times you'll be deemed disabled and your student loan payments can be made for you, as opposed to a lot of the times, whether it's in, regardless of the student loan refinancing company or the federal government, it's a different definition of disability. And usually is more of what you think of when you would think of disability, that you're kind of in really bad shape, as opposed to just maybe not being able to do what you used to do, but still living a normal life. So it's just important to consider when looking at your payments and the protections around them.
Yeah, that's a great call out. And also another option for people as they're thinking about their general plan for paying back their student loans is sort of another layer of protections that they can add, also specific to their industry. So what about adding a cosigner? So particularly for people who might be recent grads or just starting payment on their loans, just starting to build their financial background, if they do not qualify to refinance with Common Bond, they don't meet our financial standards, they can always move forward still with a cosigner. So you do have the ability to include a cosigner, and then the rate you're given will be based off of their credit and income profile instead of yours. And one thing about Common Bond, we do have a cosigner release program where after 3 years of on-time payments, the borrower can apply to have the cosigner actually released from the loan. So it's a pretty unusual thing in our industry, but it's something that we think is great because it allows people to have that flexibility to know that the cosigner doesn't have to be necessarily forever included on that loan.
And if your credit is not great, there are lots of strategies during that 3-year period to improve your credit. Some of them are very, very simple. Just to share a quick example, let's say that you have bad credit, but your spouse has great credit. Well, if they add you as an authorized user to one of their credit cards, and let's say that they don't even give you the credit card because they don't want you having the spending ability, just by being an authorized user on their credit card, you'll be treated for your credit as if you were on that card for the entire time that person was on that card. So just to give you an idea, the first credit card I got was when I started University of Florida. It was a Bank of America Visa. Still have it today. When I got married to my wife, which was, I want to say probably like 15 years later, we added her to that card and her credit shot up 120 points in a week. So just little quick tip for you guys, if you're looking to improve your credit, look to someone that you trust, that you can be added to their card. And I say someone that you trust because let's say they have great credit and then all of a sudden they do something stupid. Well, then you'll get dinged for their mistake. So it has to be someone that you trust, but it's a great way to potentially improve your credit score.
That's great. I actually didn't know about that. Very interesting. So how would someone go about starting this refinancing process? So the first step if you are interested in perhaps looking into refinancing with Common Bond, is that you would want to reach out to Chad to get access to his link. He has a personalized link that through that link, you can gain access to a special rate discount. It's a 0.1% rate discount, and then a $200 cash bonus if you do refinance with us through working with Mass Mutual and Common Bond together. So that's just that first step. You would want to make sure that you had that link from Chad so you could get access to those extra savings on top of our already low rates.
I believe Jasmine posted it in the chat, I believe.
Oh, perfect. Okay, great. And one thing I like to highlight then is kind of, what does the process look like? What are the next steps? So right from that landing page that you just saw, if you click see my rate, you'll fill out a few questions. These are things like, your name, your student loan balance, your highest degree awarded. And with that information, we're able to do a soft credit pull where we can pull enough financial information on you to be able to give you a rate quote without having any impact on your credit. So it's not like a hard credit pull, has no impact to your credit, and you can see what your rate options would be then right away. You can see your rates, your monthly payments for all the different products that you could qualify for. In our Mass Mutual Common Bond partnership, there will also be a pop-up that will ask you if you're willing to consent to share your data. This is just asking if you're okay if we share the information that you've given us with Chad to let him know that you've started this process. We don't do anything else with this data. We don't sell it. It's really just looping him in so he could then help you think through, of all these different repayment options that you're seeing, all these different terms, which one might make sense for your budget, kind of think through those broader financial goals as you make your refinancing decisions. But what I really want to hit home here, go ahead.
No, a perfect example, as Kate said, there's no prepayment penalty on these loans. So I don't know if it's possible to zoom in a little bit, but the monthly payment difference between a 20-year repayment and a 5-year is significant. So just a quick financial strategy is that if you extend over 20 years and just take the difference, which looks like over, I can't really see too well, over $1,000 a month, just imagine what the $1,000 a month can do to you if you were putting that into some sort of strategy where you're actually growing your money. And you could still take all of that growth and pay your loan off in 5 years if you want to, but you're not pigeonholed to giving, whether the federal government or whatever private refinancing company you use, you're not tied to making that extra $1,000 a month towards that company. So let's say there was a bad couple months at work where you didn't get that bonus or whatever it may be, and you're not then scratching and clawing to try and find that $1,000, your payment is lower. But if you have that freed up cash and you want to utilize it for other areas, you can build up a nest egg and still pay it back in 5 years. So just a little strategy for some of you.
Yeah, that's great. I think that's honestly kind of the best part of this relationship, in my opinion, is that's that next level knowledge that by working with Mass Mutual, you can really not only get access to these savings, but really kind of optimize your loans and really build a loan payment plan that is the best for your personal financial goals as well. And what I really want to hit home here about this rate checking process is that in just those quick little steps, you were able to see what your rate options could be. There is no need to move forward at this time. There is no cost to getting these rates. And it actually puts a hold on them with Common Bond for 90 days. So you have that time to think through, is this something that you're interested in pursuing? It's not an exploding offer or anything like that. I think that, often when we think about financial decisions, they can seem very dramatic. Like it's like if you start the application, you're jumping off a cliff, your loans are refinanced, you're not going to have time to think about this. It's really just seeing what your options are, seeing what your rates could be. And in fact, I say to people who have student loans, this is something you should be doing on a fairly regular basis, at least once a year, just as rates change and your credit might change, just to see if you could get a better rate. Like Chad mentioned that he's refinanced twice in the last 18 months, I think it was. This little process of just going in and getting your rate quote, that's all he did to then see that he had a better option for his rates. And then he could then move forward and complete the application and refinance his loans. So it's really to just see the rates is really quick and easy. And then you can make the decision if you want to move forward with refinancing.
And then tying that in with the CARES Act, 90 days, we're within 3 months of that September 30th deadline of when the CARES Act pause is supposed to end. So if you think about it, you can see what your rate would be, not do anything with it, but have it locked in so that if the Fed decides to raise interest rates, you're still locked in at that low rate. And then if you decided to refinance once the CARES Act deferment ends, you would already know what your options are. But the important thing is knowing, right? Knowing what your payments would be on income-based repayment when that pause ends, knowing what your refinancing options would be when that pause ends. Like, the people that are most educated financially are typically the ones that have the most success. And this is just another area where you can educate yourself on all the available options.
Yeah, I think that's great. It's really just about knowing what is available to you, and then you can make the best decision based off of that information. And especially like Chad mentioned, with the CARES Act planning to end in September, if we think about all of the different elements of the CARES Act that have impacted a lot of lending industries, it would be, most people would be of the opinion that sometime in the next year, rates are probably going to start to go back up from a macro environment. We've been in this historically low rate environment. That's going to have to change at some point. So it's really just a way of kind of putting a hold on a rate to see if this is something you want to move forward with in the future, and also just give you that information, give you that knowledge to know what your options could be.
Yeah, if rates don't change, a gallon of milk might cost $10 a year from now. We got to do something with that inflation. So.
Just again to highlight, so there is that rate discount through our Common Bond Mass Mutual partnership. So it's 0.1% rate discount, and then also a $200 cash bonus to you if you do decide to move forward with refinancing with Common Bond.
And I know it says clients, there's absolutely zero obligation to work with me. You can get your rate and never talk to me again. Some of you I talk to anyway regularly that I see on here. But don't think of it as, wow, I got a rate, now I need to work with Chad as my advisor. Not at all. This is completely to free up cash flow for you guys. There's really no incentive on my end, other than just to provide this education for you. So I know it says clients up there, but yeah, you get that rate discount regardless.
And one other thing that you do have access to just through our partnership and by using Chad's link is that there's dedicated access into our customer care team. Our care team are really, truly student loan experts. They're an incredible resource. If you have questions, as you're considering your options, as you're moving through the application, they're really there to be that extra help. And to us at Common Bond, it's so important that people make financial decisions that they feel good about. And as a result, our customer care team is a major priority of ours. And so they're there to be that kind of extra support as you consider your options as well. So we're going to open it up to questions now, just to kind of recap. I know we've covered a lot of information, but first, that this distinction between your federal and your private loans is actually very important right now, because there are these federal programs that you might want to consider if these would be good fits for you. And if they're not, then you know that those could be loans that would be potentials to be refinanced. And then your private student loans, you would always perhaps consider refinancing because they don't qualify for any program. So there's sort of that little decision tree as you're thinking through kind of post-graduation, what are my goals? What are my career plans? Do these federal programs make sense for me? And then we kind of pivoted just to talk about, what is student loan refinancing? And I think the key takeaways from my perspective on what is student loan refinancing that I hope you kind of hang on to is that it's free. It's just about getting you a better rate on your loan, and that checking those rates is really simple and easy, and there's no need to move forward. So really encourage you just to kind of check and see if it could be an option for you. And then of course we talked about the CARES Act, the current payment pause and interest waiver. And also as we move towards September 30th, if we do expect to see that extended or not. Again, we're kind of in a bit of a gray area right now, but I do think that by the end of this month, hopefully we will have some sort of clarity around what that timeline looks like, and then if there is going to be any type of one-time forgiveness as well. So now we'll just open that up to questions.
If Mac Lambert has a question, you can go ahead and unmute yourself.
Hi, thank you. So I have I guess it's a two-part question, and I'll use myself as an example. I'm presumably, when we do these refinancings with whoever, or we'll just say Common Bond, for example, you guys are going to take into account employment, income, other debts, things of that nature. Is that correct?
Yep.
Yeah. Okay. So for a recently graduated law student who won't receive bar exam results till mid-September and may not be fully employed until sometime after that, is there an optimal time to apply for refinancing under circumstances like that?
Yeah, so specific to lawyers, we actually have the ability to still refinance with someone if they just have an offer letter. So there is a bit of an exception to our process for lawyers that if you do have that offer, you can use that as proof of employment. So really, as soon as you have that offer letter would be the earliest that you could look into refinancing. Otherwise, sometimes people wait until maybe 6 months after they've started a job just to have that sort of the financial history in place. But I'd say that for lawyers, we do have that unique program where you can still use an offer letter of as proof of employment.
Okay, thank you.
Yeah, Mac, and just to add to that, since I would presume that you kind of just finished up in May or a little bit before then. So, unless you were clerking and earning a bunch of money, it's very likely that your income wasn't high for 2020. And in that scenario, from a cash flow standpoint, it may make sense to wait a couple of months and stay on income based, and then maybe in January or so, do the refinancing or whatever it might be, because at least for a period of time, your payments might be next to nothing. I think when I finished in 2013, my first year on income based, my payments were like $22 a month because there wasn't very much income to base it off of. And that's why the important takeaway is it should always be evaluated, at least on an annual basis, to see what your income is, what your expenses are, what interest rates are, and a whole bunch of other factors.
Thank you.
Sure.
I don't see any other hands raised. Does anyone else have a question? Okay, I think that's it. Thank you so much, Kate and
We got one in
Chad.
the chat. We got one in the chat, I believe, here.
Oh, okay, perfect.
And the answer is yes. So Common Bond is one of the few companies that actually will let you consolidate you and your spouse's debt into one loan. The question becomes as to whether that makes sense, right? And there's a lot of factors that go into that, such as, are one of you eligible for that federal loan forgiveness, right? Because if you are, you probably wouldn't want to, combine. The other question is the size of the debt, right? So I finished, I had a lot of law school debt. My wife only had 20,000, right? If we would have consolidated, her payments would have been stretched out over the entire life of my loan versus just waiting for like a nice check or a nice, bonus and taking that money and just knocking her loans off entirely. So you got to kind of look at a lot of factors as to whether it makes sense. But in terms of whether you can do it, you absolutely can do it in terms of combining spousal loans. And something that Kate, I don't know if the rule has changed or not. If any of you happen to have had a parent who had co-signed on your loans when you were in undergrad, grad school, law school, whatever it may be, they may not want to be on your loans anymore. And unless you refinance, there's really not any way to do that. And but refinancing through Common Bond, if your parents did want to be off of your loans, you are able to do that. I don't know if the rules have changed or not, Kate, but you can maybe elaborate on that.
Nope, that's totally accurate. That refinancing, if you refinance and you're able to move forward without a cosigner, you can remove the old cosigner in that process. Additionally, if your parents have any Parent Plus loans, that would be a loan in their name on behalf of your education. They can actually transfer that loan to you in the process of refinancing as well.
Although I bet since the parents aren't on this call, I bet very unlikely that if someone's in that situation, they would want that to happen. But that's another conversation entirely.
Okay, did you guys have any other closing remarks before we let everyone go? Kate and
I'm all set. I really appreciate everyone joining today. I hope this was helpful. Thank you so much for having us, and thank you for including us in this conversation, Chad.
No, thank you so much. We appreciate you guys coming here to share this very helpful information that most of us need to hear. And hopefully we can have you back in person again soon now that everything's opening up.
Absolutely, absolutely. And if there's ever any topics that anyone is interested that they want to be educated on outside of the student loan space, I know there's a lot of things to get hit with when you're, all of a sudden start, like I said in the beginning, earning money. We can provide education in any sort of, area. So, whether it's about other topics or you're just interested in your student loans, feel free to reach out. And, I don't charge for any consultations. So if anyone just needs to pick my brain on something that they're thinking of doing or not doing, we're all alumni from the law school, and it's my way, I guess you could say, of wanting to give back and to help you guys out. So feel free to to reach out to me.
Thank you. Have a good day, everyone.
Take care.
Bye.